Good morning and welcome to KBRA's webinar on coronavirus impacts and fears, a focus on U.S. airports and aviation credit. Thank you for listening in. My name is Annie Chu, and I'm a director in the business development group here at KBRA with a focus on investors. For those of you who may not be aware, KBRA is a global rating agency with more than 400 employees and 5 offices. We have 3 in the U.S. and 2 in Europe. Globally, we have rated over 2,000 issuers and transactions. I am joined by Karen Daly, Senior Managing Director and Head of KBRA's Public Finance and Financial Guarantee Ratings, Rajan Wiggy, Senior Managing Director and Head of Aviation, Transportation, and Commercial Finance Ratings, and Harvey Zackham, Managing Director of Public Finance. Karen, Rajan, and Harvey will be taking you through today's webinar on the impact of the coronavirus on U.S. airports and commercial aviation credits. As a reminder, all KBRA research and reports are available free of charge on kbra.com. We will be holding time at the end of the webinar for questions. At any point during the presentation, please feel free to submit questions through the webinar application, and the team will be able to respond at the end of the presentation. Without further ado, I would like to hand it over to Karen.
Thank you, Annie. Good morning, everyone, and thank you for dialing in. The coronavirus has become a global problem that is now spreading rapidly throughout major portions of the world. On Wednesday, the World Health Organization declared the coronavirus a pandemic. Aside from the human toll, the potential economic and financial impacts are numerous. They range from trade show cancellations to the reduction of business travel through various modes of transportation. The myriad of secondary effects can range from declines in economically sensitive taxes, such as sales taxes, to the decline in passenger traffic at airports. And remember, business and consumer perceptions and fears play an oversized role in the demand for air travel. Complicating an already complicated situation, the president banned travel from most of Europe for 30 days on Wednesday as well. Today's focus is on airports and aviation. For airports, our takeaway is that airport impacts will vary by airport, but our expectations are for strong cost recovery processes to support debt repayment. Marjan will review the overall impact on aviation in general. Next up, we will discuss the airports likely to be first affected, the impact of prior outbreaks on the U.S. aviation market, our use of stress tests, and next steps. Harvey will lead this discussion.
Thank you, Karen, and good morning. Given the far-reaching impact of the coronavirus, now officially a pandemic, KBRA thought it would be timely to study the present and potential future effects of the virus on U.S. airport credits. We maintain 14 general airport revenue bond ratings in this asset class. To gain greater understanding of how infectious disease outbreaks affect airport utilization, we reviewed CDC data related to SARS, the 2009 swine flu H1N1 pandemic, MERS, and the Ebola virus. Our findings were that outbreaks over the past 2 decades have generally been well contained, resulting in minimal impact on the U.S. air market. The coronavirus appears to be in the early stages of a rapid expansion, and it remains to be seen how effective recently implemented containment measures will be. At this point, airport travel data is extremely limited, since public awareness of the virus only dates to early January of this year. Available January data does not reflect any adverse impact, and a comparison with January 2019 monthly data indicates positive growth. However, as February and March data become available, a clearer picture should emerge. KBRA believes that U.S. airports that serve as gateways to East Asia have been most affected, as well as Italy. Major U.S. and foreign flag carriers have canceled all flights to China through the end of April and have reduced service to other destinations, including Tokyo and Osaka and Seoul, South Korea. Flights to Italy have also been canceled, as that nation is now on a virtual lockdown. It is apparent that airline bookings are off considerably and that travel cancellations will continue, at least until there is some measure of virus containment and renewed traveler optimism. We believe that the air travel impacts of the virus are evolving daily as increasing numbers of individuals, businesses, and schools cancel non-essential travel, and trade shows and conferences are either postponed or canceled. United Airlines announced last week 20% cuts to international and a 10% reduction in domestic flights, which was followed by reductions by JetBlue, American, and Delta. Perceptions, fear, and uncertainty regarding the course of the virus is driving decision-making, which is very difficult to quantify. Our expectation is that if the coronavirus gains a foothold in the U.S. and or more cases without a traceable source appear, airport passenger activity is likely to be severely curtailed. We would expect destinations where large groups of people congregate, including conventions, trade shows, tourism, and amusement venues, would be most affected. We would not expect airports to be affected uniformly, and impacts will have to be assessed individually. The one certainty is that events are rapidly evolving, as Wednesday's announcement of a Europe travel ban underscores, and each day seems to bring a new announcement. In KBRA's view, canceled flights will be reflected in reduced landing fee activity, while passenger reductions will be captured in concession activity declines. Concerns regarding airport financial health are largely offset by strong cost recovery mechanisms, as per airline airport use and lease agreements. In addition, most airports have fully funded debt service reserves and ample balance sheet liquidity. In analyzing airport credits, KBRA employs stress scenarios based on exogenous events like the 9/11 terrorist attacks or the Great Recession. Those tests are highly conservative and posit very modest recovery after the event to demonstrate the airport's ability to withstand revenue pressure. While we apply rigorous tests, our experience has been that passenger activity at most airports recovers at a relatively brisk pace following an exogenous event. Now, Marjan will discuss the impact on aviation.
Thank you, Harvey. And good morning, everyone. Karen and Harvey laid out a good summary of the fast-evolving nature of coronavirus and its impact on airports and air traffic in general. Now I focus on the potential impact on the commercial aviation industry. While coronavirus is not the first pandemic we've known, by all counts, the spread has now gone beyond unprecedented, which makes it very difficult to compare to previous shocks impacting travel. Global markets are in a state of shock, with all major indexes bouncing up and down, while economists revise down GDP forecasts for the next 2 to 3 quarters and fearing an impending global recession, which makes the situation that much worse. Let's first look at airlines who are at the ground zero of the crisis for aviation and have been hit the hardest, with no real short-term respite in view, especially in light of the most recent U.S. travel ban from Europe. Slide 10 gives a good story of this pretty large impact. The current and this week's drawing on liquidity lines from many airlines around the globe tells a lot of this story as well. Given the now global spread of the virus and importantly the heightened response to it by both passengers and governments, prediction of losses for the sector is becoming increasingly very difficult and perhaps impossible at this point. To give some perspective, on a global basis, commercial airlines carried more than 4.5 billion passengers in 2019 and were expected to generate around $580 billion in global revenue in 2020. International Air Transport Association, or IATA, has laid out a range of limited and extensive virus spread scenarios for airline revenue losses, which we have included on slide 11. The range of loss between these two scenarios is between 63 to 113 billion, but that was nearly 2 weeks ago. We now see a situation where even the 113 billion loss scenario may be surpassed. As of only 2 to 3 days ago, average cut to scheduled flights seemed to hover around 20% in the US. And whether the overall number is now quickly rising to 60 or 70% or perhaps higher in the next few weeks, unfortunately very difficult to say, since the situation is very dynamic and as mass containment efforts by employers, schools, and public authorities are being stepped up significantly, we may see even worse numbers for flight cancellations in short order. What we can say is that airline industry is in a position it's never been, not even during the financial crisis of 08-09. This kind of shock to global air traffic, especially in its current level of connectivity and importance to global commerce, has never really happened. We reiterate our negative credit view on airlines as we noted in our report last week, with now more significant downside risk given the week's turn of events. This, of course, varies by region and by several other factors like airlines' access to liquidity, their near-term debt maturities, commercial versus leisure traffic footprint, and whether they hedge their fuel costs while oil prices are in a free fall, as well as their execution of other cost-cutting measures like unpaid leave. Very important in our view is also whether they have financial backing from rational sponsors or deep-pocketed sovereign funds who have strong incentive to ease this temporary stress for long-term gain. For flag carriers with strong support from their governments, as is the case for top 3 Chinese airlines and other large Middle Eastern or Asian carriers, we feel that the pain will be there but mitigated in the short term until the situation is back to normal. For airlines with no external or parental support, the picture is very different, especially if they didn't have good liquidity buffer before the crisis. We expect the number of airline bankruptcies to increase notably in 2020, from the 20-odd names we saw in 2019 when the environment was at one of its most benign in recent history. We are currently reviewing all our rated companies and transactions. Though such pandemics tend to be short-lived, given the extent of the impact this time, even a 2 to 3 month halt to travel globally will have significant financial and operational implications for airlines and all sectors related to aviation, as well as GDP growth. Our approach to rating actions include a close review of all our airline credits in the next few weeks to determine how much losses they can withstand. As mentioned, key are current liquidity, near-term maturities, other short-term liabilities, as well as their importance to commerce and travel once the situation is back to normal. An important deciding factor as to the direction of our ratings also depend on the evolving view on the length of this crisis and whether a coordinated fiscal response from governments is forthcoming to help airlines to survive the short-term pain. We are also reviewing our rated recourse secured aircraft transactions, numbering over 100, which have structural protections in the form of credit enhancements, liquidity facility, and pay-in-kind features to ensure our stresses at the time of our ratings still hold true. But we also see a silver lining for the airline sector, in that all airlines which were fighting to survive before the crisis will exit the scene with various forms of restructuring or bankruptcies. This is a great test case for many airlines who have strived in the past decade to delever, become more efficient, and cut their ex-fuel costs, and use better technology to improve load factors. We expect that on the other side of the crisis, we should emerge with fewer number of airlines, but those who are in better financial health. Now let's look at aircraft leasing companies who own a bit over 40% of the global fleet. Slide 12 lists the top leasing companies, global leasing companies. A key difference between lessors and airlines is that most large investment-grade lessors have solid credit profiles with good liquidity as well as access to valuable unencumbered assets, with the caveat that in the current markets, their access to debt issuance in economic terms will be limited while aircraft values remain in flux. The negative impact of pandemics is not uncommon for lessors whose seasoned management teams have gone through such things a number of times through their careers. But again, we're dealing with an unprecedented situation for travel and airlines, who are the customers of the lessors. One note to make is that leases to airlines are hell or high water, meaning airlines must pay their rent even if they are not flying. However, given the current dire situation, many airlines are asking for rent deferrals, which began in Asia and now spreading to Europe and the rest of the world seemingly overnight. Aircraft lessors find themselves in a peculiar position: either accept the rent deferral, which eases liquidity for good customers in short-term crunch but long-term strength, enhancing important customer relationships, or take the risk of lessees defaulting and having to repossess, reconfigure, and remarket aircraft on fire sale. The balance lies between whether a decline in lease payments from certain lessees outweighs the potential cost of remarketing of aircraft in a bear market. All that said, decline in lease revenues, at least in the short term, is a given. Most lessors are currently in intense negotiations with airlines and are keen to assist lessees with better credit quality or parental support, under the belief that no matter how hard the impact of the virus in the near term, the rebound will be quick, as in other pandemics. Arguably, the virus has not changed the strong fundamentals of rising demand for travel. Like for airlines, though, many lessors are negotiating with banks as well to draw on their facilities. KBRA is reviewing the negative credit impact on aircraft lessors and the 9 ratings that we have outstanding to ensure the ratings remain consistent in a potential scenario of significant hits to lease revenue. Such a scenario would play out differently among issuers based on their exposure levels, and here again, sponsor and parental support is important to consider. We also expect consolidations, especially of the numerous small lessors in China, but also consolidations in the form of portfolio exchanges as flight to quality and opportunistic trade among lessors will pick up pace. Moreover, we are monitoring other related risks stemming from the crisis, like the impact on residual values for aircraft in the medium term to long term, and how our stresses in our transaction modeling will hold up. Even if this is a temporary dip, short-term values are impacted negatively, and those who must sell will surely suffer losses. Another important factor is the potential financial fallout from even a temporary recession and the impact on consumer and business spend on travel, with implications for commercial and aviation industry, as well as the health of aircraft manufacturers as they find themselves in great financial difficulty, given uncertainty regarding aircraft orders which may be delayed or outright canceled. To this end, the Boeing 737 MAX grounding and delays on Airbus Neo deliveries may ironically help airlines and lessors get back on their feet somewhat faster once the virus is contained. And this concludes my remarks, and we will now open the line for questions.
We have our first question.
Yeah, hi everyone, it's Karen Daly. We've gotten a number of questions on defaults for U.S. airport GARBs, and I'm going to answer them all together. We've taken a look over a number of decades, and we have found no defaults of U.S. Publicly owned airport GARBs. Now, the second part of the question has to do with non-rated and privately financed airports, and you may be thinking of the Branson financing, and again, that was non-rated and privately financed, and that was considered speculative grade at the time it was financed back in 2007. I know there are a number of research folks on the line, and if you need a sourceable quote, we've published an article called "The Case for Airports." You can get it on our website, and again, our research is free, and all you need to do that is an email.
Okay, this is Harvey Zackham. We have a few questions regarding how much runway, and I guess from this question is no pun intended, for employment declines do U.S. airports have before we start to see negative rating actions, i.e. outlooks downgrades from the credit rating agencies. I would say again, you can't emphasize enough that we're in sort of an information void at this point. We don't really have any employment data beyond January, and January is really before the events started to take hold in terms of employment activity. I think as we see information for February and more so for March, because it seems like a lot of the convention and trade show activity has been canceled, and the virus itself has had more of an impact in this country. We'll see more data. So it really, as the months go on, we'll have more information. Just wanted to make clear that we believe that it's not so much the effect, it's really how the airports themselves react in terms of their cost recovery mechanisms that give them some comfort as far as making coverage and meeting their obligations. And the ones that are stressed at that point are the ones that will be looked at as potential outlook changes and downgrades.
Another part of our consideration when we rate airports is management. And airports are sophisticated enterprises. They typically have very nimble management teams, and we expect that will play into the individual airport's credit profile as well.
So some questions also have come up on general aviation that I will start looking at. One was about what are the downside risks of potential renegotiation of guaranteed contract, which I understand it's the lease contract. I think I mentioned in what I said earlier that there's definitely a downside risk. And it looks like no matter how you look at it, there are going to be losses, because even with the large airlines where aircraft lessors would be willing to make some negotiations and have some deferrals, that you're going to have some temporary losses. The extent of it, I think it's a little bit difficult to tell, but we are on a daily, we're talking to our lessors to try to understand how they're dealing with it. It's a little difficult to tell the extent of it right the second, but there are going to be definitely lease deferrals. One important thing though that the lessors have told us is that they have, even if they do provide deferrals to certain lessees, that they will have to repay it back on a schedule that they will send to them within a few months after the virus is contained. Let's see, another question that's coming that's interesting is how the fall in fuel prices may offset airlines' profitability given passenger declines. I think that if the flight cancellations were not as bad as what we're seeing, certainly a fall in fuel prices would offset some of the losses. The problem is that if you're not flying, you're not gaining that much benefit from lower fuel costs. But it is something, and it helps. But the level of losses really, really outweigh any cost savings you're getting from fuel. I think that most airlines are really focusing on ex-fuel costs to try to contain their losses. But even then, I think as IATA has predicted, at the worst case scenario of 113 billion, possibly higher, you're going to see substantial losses to airline profitability in 2020. And we also understand that IATA is, as we speak, is working on producing new numbers given what's happening. One other question that's interesting that came in, I just want to mention that many people are concerned about what we're doing on aircraft ABS. we're equally very, very involved in reviewing all those credits, rerunning stresses. We can't really tell anyone about any lessors, airlines, or aircraft ABS, which may be subject to any kind of rating actions until they happen, but we're in close contact with all the servicers and trying to understand which ABS deals may be at risk.
This is Karen Daly again. We've got an interesting question about sales tax. What will be the impact on sales tax collections of sharply lower airport traffic? That's a great question because as we know, airports are economic drivers with additional multiplier effects. In terms of sales tax revenue bonds themselves, I think we're going to see an initial pop in sales tax collections as a result of panic buying, and then we'll have to see in the following weeks and months what happens to sales tax activity. One of the things we do with sales tax revenue bonds is, again, we stress them under various scenarios, and there is often the presence of a debt service reserve fund, so that's a consideration as well. But the behavior, it's an interesting question because the behavior of the consumer is driving sales tax and then sales tax collections. So we are and will be watching this very closely in the upcoming weeks and months.
And just to add, in terms of the airport itself, the effect would really be more on the actual sales themselves rather than the tax, since the municipality in which the airport's located would be collecting the tax. Similarly, in terms of fees for certain airports where the city collects transportation network company fee for entering the airport, there are cases where the airport does benefit from that, but there are other cases where the municipality gains that also. So you'd have to evaluate both situations.
And this is Marjan again. Another question that came in that's pretty interesting is to the impact on regional airlines versus the majors and the ones who have international routes, international footprint. I think it's really interesting that if you look at most U.S. airlines have a lot of their revenue actually comes from domestic flights. So if you look at it that way, you would think that the regional airlines, at least in the U.S., will do a little bit better because nearly all their flights are essentially domestic. At the same time, given the intensity of the situation with the virus, it might be that the whole country is stopping to fly. So it's a little bit harder to tell. But just by virtue of the fact that you have most of the flights are domestic, that might help.
Okay, we have a question as far as what is the key metric KBRA will be monitoring to know if this crisis will have a material impact on airport and airport authorities' ability to make their debt payments. And as always, when we evaluate airports, the key factor will be the employment activity, to see any changes in that and to see where the changes are occurring. And along that same note, we would be looking at load factors for existing flights, reductions in frequencies or route elimination. And those would really be the factors we would start at and try to get a handle as to what's driving that.
Thank you, Karen, Marjan, and Harvey. This concludes today's webinar. Thank you, everyone, for your time and for dialing in today.
Thank you.
Please email the team. The slide deck will be available on the webinar, as well as the reports on the airport and aviation that we published in the last week. We're always happy to discuss, and we encourage questions from issuers, bankers, and investors alike. I'm sorry we couldn't get through all the questions, but please feel free to follow up with any of us next week. Again, thank you. We very much appreciate your time, and have a nice day.